Guess what? Most investing advice you've heard is completely wrong. The key to becoming a millionaire isn't finding the next Nvidia or Bitcoin or doing some kind of perfect market timing. It's actually this: doing nothing. It's really deceptive because the financial industry as a whole has a vested interest in things seeming and being complicated. If things are complicated, there's a barrier between what you and I can do and what the pros can do. We're intimidated by that, and that means we need to rely on them. It means we don't know how to get things started on our own, and it means they can trick us into doing things like day trading, like sports betting, like options trading, like all of these different little movements, all of our activities that are buying and selling and using their services on our phones or on our computers. That makes them profit. Every move we make makes them profit. But what if I told you that amongst the regular people like me and you, the wealthiest, most successful, best performing investors have mastered this one crazy discipline of doing nothing? They're masters of inaction. Today, I'll show you why that investing behavior helps you to perform better than all of your peers, and I'll back that up with psychological data and historical data that might both surprise you. The true test of wealth building is being able to weather storms. So let's go through significant market crashes over time and help understand why exactly the cornerstone of building wealth is inaction. We'll just focus on our lifetimes as millennials, elder millennials, Gen Z, a few people a little bit older than that. But for us, the first real thing that we could have noticed is the dot-com bubble. This happened between 2000 and 2002, and this is when the tech-heavy NASDAQ collapsed. It lost nearly 78% of its value from peak to trough. Imagine a 78% loss today. People would be freaking out. And back then, they did. A lot of people panicked. They said, this is too much. I've lost too much. I have to stop the bleeding, and they sold. What that means, if you're not familiar, is they took their investments and they said, I want to stop being invested in this. Take all of the money out, sell that to whoever wants to buy it, and give me whatever cash is left. And here's why that was an awful decision. Between October of 2002, when it hit rock bottom, and the end of 2007, the NASDAQ gained over 130%. So let's say they had the worst possible ride. They went down 78%. They gained 130% after that. If you were waiting for some clear sign that things were going to turn around, that you knew that things could be trustworthy again, that you should get your money back in there, you probably waited and things improved 100%. And you went, okay, now it's safe. And all you got was that last little sliver at the top, that last 30%, but you would have missed the majority of that gain. Fidelity actually studied this, and people who waited 6 months from the bottom to reinvest missed out on average 22% of the returns they could have gotten. It's a few months. It's not even years of decision making. It's just sitting on the sidelines going, whew, that was crazy. Well, maybe I should think about doing that again. Boom, you've already lost. Speaking of losing, the 2008 financial crisis was rough. Between October of 2007 and March of 2009, the S&P 500 plummeted by 57%. It's one of the worst, steepest crashes in modern history. But here's a crazy thing. The 10 years after that, from March 2009 to the end of 2019, the market returned 495%. There are people who really felt hurt by losing so much value in their net worth, by delaying their retirement, by just seeing their account value plummet. And so they waited and waited and waited until things really felt like they turned around. I mean, I remember this. I was graduating college in 2008 and 9, and I felt like, oh my gosh, I will never get a job. It's impossible to find work. Everyone who had job offers was getting them revoked. Remember, we went out to eat at a restaurant, and the waitress was trying to sell us her truck. She was like, hey, you guys are in construction. Anybody want to buy a Dodge Ram Daytona? It's really great. It's less than a year old. She couldn't afford it. She got laid off from her construction job. She was literally waiting tables, trying to unload her truck on any dude who desired a truck. It was a crazy time. But people who took action during that time lost more than the investors who did. Then more recently, we're all familiar with this, the crash that the pandemic occurred in 2020. In 33 days, the S&P 500 dropped 34%. It fell off a cliff. And I've heard personal stories of people who during that time freaked out, sold, and held on to cash since then. It took the market 181 days to recover those losses. So it was less than a year. That's like, what, half a year for everything to go back to normal when it comes time to look at a stock market valuation? Technically, that was the fastest recovery from a bear market in history. By the end of 2020, the S&P 500 was up 16% for the year, and by the end of 2021, it had gained over 100% from its pandemic lows. JP Morgan did an analysis that 6 of the market's 10 best days in the past 20 years occurred within 2 weeks of the 10 worst days. Think about that. It's like a trampoline. The market comes crashing down, and almost just as fast as it crashes, it bounces off the bottom. The thing is, nobody with predictive AI-generated investment advice, nobody who's read 40 or 50 investing books, nobody who's got a great hunch can predict the timing of exactly how that's going to happen. And so for us to rely on ourselves and our own understanding to pick those times and know when to invest, when to get in, when to get out, we're going to lose. There's going to be an opportunity cost there of 20, 30, 40, 50% returns that we're just voluntarily giving up. So what I'm saying here is the biggest risk to our investing portfolios isn't market volatility, it's not trade wars, it's not pandemics. It's our own behavior and our response to market volatility. Average investors have been proven to underperform just a basic stock market index. And the reason for that is because they buy and sell at the wrong time. We think that somehow we can outsmart and outtime the market itself, but we can't. So how much worse does the average investor do? Well, over the 30-year period that ends in 2020, so what is that, 1990 to 2020, while the S&P 500 returned an average of 10.2% annually, the average equity fund investor earned just 5.96%. You're missing out on 40% of the gains that you could be having by trying to buy and sell, by trying to time the market. So here's the counterintuitive truth about investing. Market crashes aren't anomalies. They aren't the end of the world. They're actually just part of the normal investing cycle. This is crazy. Since 1950, the S&P 500 has experienced 36 corrections of 10% or more, 12 bear markets of 20% or more drops, and yet it still has delivered an average return of about 10%. That's a lot of volatility. 48 events where people were crapping their pants, were really freaking out. That means a correction where it goes down 10% or more happens like every other year. Every 2 or 3 years is going to be a correction. Then about every 6 years, there's going to be a bear market. This has just happened. It dips and it flies, and it dips and it flies. And this is what we should expect whenever we're investing. So if you want to be a millionaire, you have to have a mindset shift that goes from fearing those times to expecting them. We have to realize that these are, number one, inevitable. It's going to happen, just whether or not it's going to happen this year, next year, the year after that, we're expecting it. Number two, we have to realize those down times are temporary because a bear market doesn't last forever. Unless the literal world is coming to an end, it's not going to last for forever. Number three, these are opportunities. So it doesn't mean that we sit on a bunch of cash and we wait to buy the dip, but we can almost celebrate whenever we see these dips happening because we go, okay, well, what that means is that my regular investing, whether that's into your 401k, whether you're dollar cost averaging into a Roth IRA or a regular IRA, whatever that looks like for you, it means your dollars are going to go further. You're going to buy a bigger percentage of each company that you invest in because the market's down a bit. You go, okay, this is great. Then the market goes up. Okay, this is great. The funny thing is that even though those market downswings feel terrible and it feels bad to see your account go into the red, it's the price of admission. And the people that can hold fast and do nothing in response to them are actually the ones who are going to win. In most other things in life, a millionaire mindset isn't going to lead you to doing nothing. Because if you want the kind of income that gives you enough money to invest a lot of money, well, then you can't be doing nothing. You've got to be hard charging. You've got to be really adamant. You've got to be willing to negotiate. You're working hard. You're making moves. When it comes time to actually invest, you have to take action and set everything up. Set everything up to happen automatically, to where you're dollar cost averaging every time you get paid or every day, however often you want it to be, but make it a regular automatic thing. This requires action, a little bit of research, a little bit of understanding. You've got to decide, who am I going to invest with? Vanguard, Fidelity, Robinhood, whoever. All these other supporting habits around what it takes to become a millionaire require action from you. And then counterintuitively, just this one, which is, what do you do when the market crashes and freaks out and drops and everyone's, yelling that the market is dying and your hair's on fire and what are we going to do? That's when you play it cool. That's when you stand rigid in the middle of a storm and do absolutely nothing. It's crazy, right? It's the opposite of what our human nature tells us to do. Normally we react to a threat. Normally we run away from danger. In this case, we have to go against that nature and respond with stoicism, with a willingness to maybe delete an investing app every now and then, or just choose to not look at it, because the more you're looking at it, the more that pain you feel, the more you might take a bad action and sell something. So the trick is to do nothing. And this has worked for us because my wife and I have become millionaires in our 30s. And a lot of that is because all we've done is invest. We've bought and held. We've bought and held forever. We've never sold a substantial amount of our investments. Everything has been reinvested. If I've ever sold something, it's because I'm going to turn around and reinvest it in something else. So it's not a market timing thing. It's just an adjustment thing, a portfolio allocation decision. It's taken us about 16 years of work and learning and investing and staying the course to realize what it's taken to become millionaires. Actually, I guess that's only been like 14 years, because it's 16 years till today that we actually started investing. but we became millionaires like 2 years ago. So between our house and our investments, we're millionaires. We're coming up on the time when just our invested net worth alone will be over $1 million. And that's really exciting. The hardest part is adding value in the world to get paid and then deciding to not spend all of that money. And you see what money you have, what you could be buying, what your neighbors are doing. It's really easy to talk yourself into, well, I deserve that thing. I should buy that for myself. That would be nice. I've worked really hard. You got to put the kibosh on that and instead say, I'm going to invest 20%, 30%, 40% of my income. And then things get really crazy because at this point, our investment portfolio is growing at a double rate of the money we're bringing in every month. So we go to work every day. We work really hard. We add value to our company, to the world, to our state, to the people around us, and our investments that we do nothing to maintain, that we just go to sleep and they make money for us, are at double the rate of our income right now. It's ridiculous. Our money is better at making money than we are, but you don't get to experience that if you're always playing around, putting money in and out, finding the next best crypto coin, finding the next best option strategy from somebody on TikTok. We don't mess around with that stuff. We save, invest, dollar cost average, leave it there forever, until and if at the point we say, okay, time to pull the plug. We're going to retire, or we're going to partially retire. Maybe you downshift and only work 2 days a week. Maybe you get a really easy job that you like that's just for funsies, that gives you great perks. Like I would be a driving instructor like tomorrow. Be super fun. There's a racing school in our state. I could go down there, volunteer, and just trade for track time or something. That would be a dream retirement job. That kind of thing is enabled when you have a portfolio that's big enough to support your living expenses. So that's the plan and the dream, and the goal is to have that level of freedom. Maybe it is more than $1 million. You know, $1 million isn't what it used to be in the 80s. To have $1 million invested means you can probably draw $40,000 per year safely and not run out of money. So maybe you want to have $2 million. You want to be a double millionaire before you can have $80,000 a year to withdraw and live that lifestyle you want. But in any case, every step along the way, becoming a millionaire and immediately after that is more and more freedom. It's more options. It's less dependency on credit and debt and your employer and anything else that might throw a curveball in your life. You've just got more control and more options because you've got this money. Okay, maybe you have to liquidate a few stocks here and there because you need to replace your roof. That's fine. It's a heck of a lot better than taking out a loan from some bank at 9.5% interest, right? It's amazing the options that you get every step along the way. Whether you're at $100,000 or $1 million, you have a lot more freedom and options than somebody who's broke. So that's what we're doing here. If you want to watch more of that, subscribe. See you later. Secret comment word is million. Bye.